Hello everyone, welcome back to Investing Sucks. My name is Eric and thank you so much for tuning in. So today we're going to be taking a look at a company called Converge Technology Solutions. Now I had a few different subscribers mention this company to me. They said I should take a look at it, so I figured it'd be worth doing a video on. And I gotta say, I was pretty impressed by what I saw with this company. This is definitely a company that has pretty good growth potential going into the future, and it's not priced too aggressively like a lot of companies are nowadays that do have growth potential. So I think this will be a good one to learn about. So we'll take an in-depth look and look at the numbers behind this company. And also, the channel has now surpassed 100 subscribers, and we're actually way past that now. We're at about 140 subscribers as of creating this video. So thank you so much for everyone for subscribing, all the likes, comments, support in the channel. I greatly appreciate it. Also, I began to notice a few people leaving comments on my latest videos, requesting other stocks that they'd like me to look at. And I think as my channel continues to grow, hopefully it continues to grow, I'll probably get more people requesting stocks that they'd like me to do a video on. So if you do have a stock that you're looking at that you want me to do a video on, feel free to comment it in my latest video. But just keep in mind, guys, there's thousands of stocks out there and only so many hours in a day. I can't accommodate every person's request. But what I would like you guys to do is go to my latest video and check the comment section and see if someone has already left a comment requesting the specific company you want me to take a look at. And if they have, then please like that person's comment. That way I can see if there's one comment that's mentioning a company that is getting a lot of likes, then I know it's probably worth doing a video on that company. So if you would like that to happen, then just drop a comment in my latest video, whatever company you want, and hopefully it gets a lot of likes, and if it does, then I'll cover it in a future video. And if you do want to request that I do a video on a certain stock, one thing I will ask is that you keep it limited to TSX stocks specifically. Just because I think that TSX stocks get a lot less coverage in YouTube in general. So for me, myself being a smaller channel, it's easier for me to make an original video on those companies and actually have it get a decent amount of views. For example, if I were to make a video on a company like Palantir, for example, you know, one of those more talked about US stocks, my video would just get drowned out and all the other hundreds of videos on there that are about Palantir and analyzing Palantir's financial statements and all that stuff. So I just think for me personally, where I'm at with my channel now, it makes more sense to focus on TSX stocks. I also don't really want to cover penny stocks, so anything that's, you know, $2 or $3 or below that will also be off limits. So just keep that in mind if you do want to request a company. Another thing I want to comment on before we get into Converge Technologies is how I'd like to structure these videos going forward. So what I want to do is have a specific order that all my videos follow whenever I'm going over a company. So that way, when you guys click on one of my videos, you know exactly what to expect. It's going to be the same order applied to each company. And it also prevents me from being able to kind of influence how I look at a company with my own personal bias, just by forcing myself to look at the same things for each company in a specific order. And what the order will be is it will always start with valuation metrics. So this will be looking at things like a price to sales ratio, price to earnings ratio, price to book, anything like that, which I think is a good thing to start with because it kind of sets the tone for the video. And it kind of puts into perspective how the company is currently being valued by the investing public at large. The next thing we'll be doing a general business overview of the company. So talk about their business model, their business strategy, as well as just any recent news about that company. That way everyone who's watching the video is on the same page and we all have good general information about what the company does, who they are, where they're going, and that type of stuff. The next thing I'd talk about is growth prospects for that company as well as the industry as a whole. Now this is going to be a very general category. It can really include anything that I think is important for investors to know. So it could be trends in the industry that they're operating in, just anything about the industry, you know, what certain things is the company doing that will lead to them to maybe grow in the future, or what risks are there that could prevent them from growing into the future, that type of stuff. And really the whole point is to kind of just pose questions to you guys if you are investors or potential investors in a company that you should kind of get answers to in order to determine if this investment is a valid long-term investment. The next thing I'll get into is historical financial data. So I like to look at 7 years of historical financial data. So that could be revenue, earnings, EBITDA, shares outstanding, free cash flow if they have free cash flow, that type of stuff. So 7 years if it's available, but if it's a newer company, they don't have 7 years, or if they're kind of an upstart company, and they only recently got to a point where they're getting close to becoming profitable, then maybe I'll just look at one set of financial statements just to be a little bit more concise in that, which is the case of what I'll go through with Converge here, because they are a much newer company. And then the last thing I'll look at is I'll attempt a valuation at that company and then try and come up with an average annualized investment return. So this valuation could be done using a free cash flow method if they have consistent and predictable free cash flow. If not, then I'll probably use a multiple of earnings method, or really whatever method I think is best suitable for that company. Now keep in mind, guys, I am an accountant, and what I really like to focus on is numbers underlying a business. So I won't focus so much on kind of the growth prospects of a company and talk about how they're going to keep growing to insane rates and go to the moon. Just because that's not really where my interest is. I'd rather focus on the actual facts of the company, the cold hard numbers that aren't subject to any kind of subconscious interpretation. Which I think is the better approach to take when it comes to investing anyways, because focusing too much on the future of a company, the future that is yet to materialize, can be pretty dangerous because the future is unknown, right? We all like to think that we have a good idea of where the world is heading to, but in reality we don't know that. So that's really what you can expect from my videos going forward. Okay, but anyways guys, that's enough housekeeping from me. Let's actually jump into the analysis and start to take a look at Converge Technologies and start with the valuation metrics. Okay, so let's look at how this company is being valued in the public market. So I've just pulled up Yahoo Finance here, and we can see they're a $2.1 billion company, and they have a very reasonable PE of 1,865. Just kidding about that, guys. The reason this PE is so high is just because they had a very small EPS. It was only about 1 or 2 cents. They just recently started turning a profit. So pretty much this PE, you can pretty much disregard that. The price to sales, though, isn't actually as high as what I kind of expected going in, 2.07. So if they're a $2.1 billion company, that tells us they had just under $1 billion in revenue. So not too expensive on the price to sales ratio, and the price to book, 9.7. Obviously that is a bit higher, but it's because it's a smaller company, it's growing, we expect it to grow, which is why you see that a bit higher. So overall, the valuation metrics aren't as alarming or don't strike me as overly expensive, just given what we already know about this company. So with valuation metrics like that, we do expect this company to have pretty good growth potential going forward, right? It wouldn't necessarily be priced at 2 times sales or have basically a $2 billion valuation with only just under $1 billion revenue if there wasn't some growth potential built in there. So that's what we're going to be looking for as we kind of go further and look at this company. Okay, so now let's give a quick overview of this company. So similar to the last company I covered, which was Well Health Technologies, Converge is doing the same thing where they're doing a roll-up strategy. So if you guys didn't watch that video, what the roll-up strategy is they're basically just acquiring a bunch of different IT service providers, which is cloud computing, virtualization, data storage, digital infrastructure, a whole bunch of different stuff, cybersecurity as well. They're acquiring different regional kind of companies with the goal of creating a much larger, more consolidated company that leads to better operational efficiencies and cross-selling opportunities. So the company as a whole, the goal is to become more than just a sum of its parts and kind of create value by combining all these businesses. Now here I've gone to page 3 of their management discussion and analysis for March 31st, 2021. So their first quarterly filing. And what we can see here is a list of all the companies that they've acquired so far. So if you are someone who is interested in investing in this company and looking into this company a bit further, you definitely need to look at these companies and learn about them, because these companies here is really what Converge Technologies is. They're a combination of all these companies, and their goal is, by combining these companies and future companies they acquire, to achieve operational efficiencies and create value as a whole business rather than these just being businesses on their own. So then if we scroll down to page 4 of their MD&A, we get to this section here which actually details their strategy. So this is a good thing to read. So right at the top we can see here it says identify and acquire. So that's what they're trying to do. Converge's strategy is to identify and acquire ITSPs, which stands for Information Technology Service Providers, that offer a multi-vendor technology solution for clients. And then if we look down here, it talks about Converge has acquired and built public and private cloud capabilities that transform ITSPs into hybrid IT providers. Now, what I think they mean when they say transform ITSPs into hybrid IT service providers is they want to acquire a wide range of companies that encompass many things like data storage, digital infrastructure, virtualization, cloud computing, public and private cloud computing, cybersecurity, a whole bunch of different stuff, and then give their customers access to whatever set of those services they require. So say you have one customer who they want cloud computing and they want data storage, but they don't need cybersecurity services because they already have another company that provides them with that. then they can come to Converge and say, these are the things we need, and then Converge can say, yes, we can offer you those things. So it's kind of offering tailored solutions to their customers, just giving them access to whatever they need, because companies have different needs when it comes to this stuff, just depending on what stage they're at in their business life cycle, how much money they have to invest in this type of stuff. Okay, so now let's look at this company's business model. So how they actually generate revenue, which to learn about that, we're going to go to their management discussion and analysis report. Okay, so here is a breakdown of their revenue. So this is just for the 3 months that ended as of March 31st, so 2021 and 2020. So March 31st, 2021, we can see about 300 million in revenue. So they are actually on pace to grow quite a bit. And there was pretty big growth from quarter to quarter, which was expected. They made a ton of acquisitions. Most of it is probably just growth through these acquisitions and not organic growth in the businesses. But product revenue makes up the vast majority of their revenue, which product revenue is probably much lower margin because that encompasses, as we can see here, product revenue, which includes hardware and software. So hardware is probably a lot less margin than there is on the software. So really, what you want to see going forward is more of a focus on the software and then maybe the managed services as well as the professional and other services, which make up a lot smaller of a percentage there. Okay, so now let's move on and talk about this company's growth prospects. So what trends are there in the industry that they're in that are going to lead them to grow into the future? So we know that they're going to continue to make acquisitions, right? So don't be surprised if revenue continues to grow at a very fast rate on a quarter-to-quarter basis and on an annual basis because it's expected, right? They're making tons of acquisitions. They're issuing shares to make those acquisitions. So if you do want to invest in this company, you are going to have to live with dilution, right? It's just a fact of investing in this company. Because they're making acquisitions, they have to pay for these acquisitions somehow. And the way they do that is by using cash, obviously, but also through issuing shares. Now, they also mentioned in their MD&A report a few things that I thought were interesting. If we're focusing more on the organic growth side rather than just inorganic growth, which would be just from buying companies. So they mentioned in their MD&A a few things. So one is the shift to a remote work environment. So obviously, with that thing that happened in 2020, a lot of companies were forced to work remotely. And I personally think that this is a trend that's going to continue into the future. I don't think it'll be as extreme kind of as it was in 2020. I do think a lot of companies, once they can go back into working in an actual office space, they will do that. But I definitely think there are going to be a lot of companies that stay permanently in the remote work environment. But that remains to be seen. But I do think that it is something that will help this company because if they do shift to remote work, they are going to need the services that this company provides. And then they also talked about the cybersecurity things, which I think the cybersecurity business is a great business to kind of think about investing in, because if you think about it, cyber criminals in general are always getting more and more creative with the ways they hack into companies and, steal data, all that type of stuff, right? So cybersecurity is something that companies are always going to need. They're always, pretty much as long as people are online and doing things online, which is probably the way things will be for the foreseeable future, companies and individuals in general will need cybersecurity services. So I think providing those services is a great sign for this company, which could lead to pretty good organic growth into the future. And I'm sure that those two trends I just mentioned are pretty big reasons why a lot of investors are looking at this company and why their valuation is what it is today. Now, obviously, I'm not an expert on cloud services or IT managed services or anything like that, so I'm not going to stand here and pretend like I know what the future of this industry is going to be, because obviously I don't. But if anyone who's watching this video does have some kind of experience in this industry and does have some insight that they'd like to share, I'm sure me and a lot of the viewers would greatly appreciate some insight. So if you want to comment that down below, we'd all appreciate that. Okay, but now let's move on to looking at historical financial data. So I'm just going to look at 2 years of historical financial data because this company is fairly new. They were incorporated in 2016, I believe. So I can't go back and look at 7 years. So we'll just stick with 2 years. It'll be more concise because I can actually show you the financial statements. But there is one thing I want to show you guys before I get into any of that. Okay, so here I've gone to their 2020 year-end financial statements, so December 31st, 2020, and I've gone to this section here, which is in their audit report, which is called Key Audit Matters. Now, why this area is important for investors is because key audit matters represent specific areas of the audit the auditors did when they were examining their financial statements to make sure they were accurate, that they had to pay specific attention to. So here it talks about goodwill impairment. Now we know that this company is doing a roll-up strategy. They're acquiring a lot of companies, And because they're acquiring a lot of software companies usually don't have very many assets on their balance sheet. So a lot of the transaction price that they pay when they buy these companies gets allocated to goodwill, which goodwill is basically the amount that a company paid for another company that they acquired that was in excess of the net assets that they received when they acquired that company. So goodwill impairment, that occurs when the goodwill of the company, so they call it a cash generating unit, which is really referring to the actual underlying business that they acquired. So if that becomes impaired, which means the business they acquired starts to have lots of losses, they're not doing very well, then goodwill could become impaired. And because the goodwill on their balance sheet is going to be so significant due to the amount of acquisitions they're doing, a goodwill impairment charge could represent a very large expense. Now, obviously, that depends on whether or not the businesses actually end up performing poorly, but it is definitely something you would want to take note of because it's very hard to estimate goodwill, and it's really up to the companies to decide if there is goodwill impairment or not, and the auditors kind of have to take the company's interpretation of that and kind of roll with it a bit. It's very hard to audit, so just something to keep in mind going forward. Okay, so next let's look at the balance sheet. So I've got their most recent updated balance sheet information here, which is as of March 31st, 2021. So we can see about $68 million in cash and a very significant receivables balance here. And then total current assets equal about 525 million, which we'd want to compare that to total current liabilities, which is down here, which is 554 million. So they actually have more current liabilities than current assets, primarily due to this very large trade payables balance here, which I tried finding out more information on why this balance here is so high, and I couldn't really find anything specific. It's probably just because they would delay paying off of some of these payables to a later date in order to free up some more cash that they could use to go and make acquisitions, because some of their acquisitions are smaller and it's better to use cash to make those. So that's probably one of the reasons why that is the way it is. Also, when they acquire companies and the companies they acquire have payables balances, that gets included in there. Same with everything else, all the other assets and liabilities they acquire. So that was one thing that kind of confused me looking at it initially. And then we also want to look at the debt to equity ratio. So total debt is total liabilities, which would be this number here. So just under 600 million in total liabilities. And then total equity is only 188 million. So actually their debt to equity ratio is pretty significant. They have a lot more debt than they have equity, and a lot of their equity is just from common shares, which is just money they've received from issuing their common shares. And then we also have exchange rights. And then they have this deficit, which is kind of the accumulation of losses that they've incurred since they became a company in 2016. So wasn't super impressed by this balance sheet, but keep in mind they do have the ability to always issue shares if they do need cash. So I personally wouldn't be too worried about any kind of short-term liquidity issues or solvency issues with this company, at least for the next few years. Hopefully these things will start to change as the company grows and becomes more profitable. Okay, so now I've jumped back to their December 31st, 2020, so their annual report here, to look at the statement of changes in equity. And what I'm looking for here is this column, mainly to look at how common shares outstanding have changed. So if we go to their balance as of December 31st, 2018, we can see about 75.7 million shares outstanding. And then if we go to December 31st, 2020 down here, it's 143.6 million shares outstanding, which that number has now increased more. I believe currently it's at about 163 million shares outstanding. So very significant dilution there, which is really what you'd expect, right? They need a lot of cash and a lot of shares get issued when they go out and make these acquisitions. We can look at the actual source of it. So for example, 51 million shares issued here due to kind of from their public offerings. That was just them selling shares to the public to raise money, which they make acquisitions with and that type of stuff. They also have, you have to look at convertible debentures. So they may have convertible bonds that they've issued that can be converted into common shares that will further dilute shareholders. These are all things you need to take note of. You need to know what type of convertible securities they have in place, because that is something else that's going to dilute you if you are a common shareholder in this company. All right, next I want to just look at the cash flow statement. So I've gone back to their March 31st, 2021 quarterly filing. So this is comparing December to March of 2021 and then of 2020 here. So it's only for a quarter, but we can see it starts with net income. So we can see they actually were profitable. They have $4 million of profitability. They weren't profitable last quarter, so that's a good sign to see. They are actually generating profit, but they aren't generating positive cash flow. Because if we look down here for cash flow used in operating activities, it is negative here versus it was very positive right here. So that's kind of confusing if we look at that initially. Like, why was net income positive and then negative, but the net income here was negative and this was very much positive? Well, the biggest reason really is kind of these adjustments you see here, especially with this. If we look at the changes in that item there, which is their trade and other payables, this was a significant cash inflow, which means the trade payables balance increased, versus this was an outflow, which means it decreased because they had to use cash to pay down some of their payables. So that's one thing to kind of look at, I guess, in future cash flow statements, because it does seem to have a very big impact on their cash position. And then if we scroll down a bit further, we can look at their purchase of property, plant, and equipment, which, if we're calculating free cash flow, it's cash flow from operations minus any PP&E purchases. So that would be this one here, purchase of property, plant, and equipment. And it's quite low. Like here they actually had pretty strong free cash flow. They didn't have free cash flow here due to the negative number there, but it is a software company, so you expect very little property, plant, and equipment investments. And usually if these companies do end up performing well, they can be very good at generating free cash flow just because of how low the PP&E number usually is. Okay, so now we've talked about the company, we've talked about their growth prospects, we looked at historical financial data. Let's actually get into the valuation now. So the way I valued this company was using the EV/EBITDA multiple of earnings approach method. And I went into the year 2025. So I assumed it's about halfway through 2021 as of now. So what if we bought the shares at their current price, projected their market cap in the year 2025, and then try to see what type of an average annualized investment return we could expect if we hold on to them for that period, just given reasonable assumptions. Now, because they are an acquisitive roll-up strategy type company, this is going to be very hard to do because their future value depends a lot on what companies they acquire, right? Because the companies they acquire will impact what their EBITDA margin will be, which still remains to be seen. If they focus more on service-oriented companies, it'll be higher, but if they're focusing more on hardware companies, it's going to be a lot lower. So it was kind of difficult to do, but I think I got a pretty good shot at it, so I'll show you guys that now. Okay, so here's the Excel file where I did it. It's a super simple valuation model. The whole point of this valuation model is to just try and put their current market cap into perspective and see, okay, what type of revenue growth assumptions and EBITDA margin and EV/EBITDA multiple are reasonable to assume, and then what type of future market cap can we project if those assumptions come true. So I started with their revenue. I segregated out into product revenue and service revenue and have historical data for 2020 and 2019. So from 2018 to 2019, revenue is up almost 50%. That's this growth right here. So it went to 688 million. All these numbers, by the way, are in millions of Canadian dollars. And the current year is about 950 million. So 38% growth from 2019. So then going into the future, I assumed 35% growth into 2021, 35% again into 2022, and then 25% growth for 2023 and 2024. And then in 2025, I assumed again 25% growth. So basically what I'm projecting is in 2025, the revenue will be about $3.4 billion, which obviously seems quite high now, especially because they're only not even at $1 billion yet. But remember, they are doing tons of acquisitions. We expect their revenue to scale up quite fast. And this revenue will be a blend of organic growth, just if their services start to sell more and generate more revenue, as well as growth through acquisitions. I then take a 12% EBITDA margin on that. Now, one thing to keep in mind is their current EBITDA margin is somewhere in the range of 5 to 6%. So you may be wondering, where are you getting 12% from? That seems very aggressive. Well, one thing I read about this company is their plans for the future are to focus more on the service-oriented side rather than the product side, which is selling things like hardware, which is much lower margin. So it definitely makes sense to assume that their margin will increase. And also keep in mind, there's cross-selling opportunities between the businesses they acquire. There's also increased operational efficiencies because they're able to save costs. So these are all things you expect the company to achieve, but I didn't give them too high of an EBITDA margin because they are an IT service provider that is a licensed reseller for things like cloud services and data infrastructure, that type of stuff. But anyways, that gives us a 405 million EBITDA. I then take a 12 multiple, which I just looked at the median multiple for similar IT service providers. It is going to be lower than kind of your traditional software companies just because it is a IT service provider. They don't kind of create their own software. Like I said, they're a reseller, so you aren't going to expect to pay as high of a multiple, like 15 or 20 for a company like this. And that's really what the historical data showed. So 12 seemed about kind of in the middle. So that gives us an enterprise value of about 4.9 billion. And then debt, I took $250 million in debt. Now, normally companies like this don't have very much debt. It's kind of hard to get debt as a software company because you don't have very many assets to use to secure debt. But I did see on their balance sheet, they did actually have quite a lot of debt, which they have through asset-based lending. So they have a revolving credit facility that depends on however much assets they have. So if they acquire more companies, their assets will increase, which means they can extend that credit line and get access to more debt, which I'd expect them to. So 250 million was kind of just a rough estimate of what I expect. Could be higher, could be lower, but overall it doesn't really affect their enterprise value that much, especially when we factor in cash. So they currently have about 68 million in cash. I just assumed 150, which seems reasonable to that balance will increase as the business grows. Then we get an estimated market cap of 4,764 million. Now, shares outstanding. This one was hard to determine because we know the amount of shares outstanding is going to depend on a lot of things. And even if you went directly to company management and asked them, how many shares outstanding do you think you'll have in 2025? They won't know. It's going to depend on a lot of things like acquisitions, convertible securities, also them just issuing shares to the public. But we know for a fact that it is going to go up. So I just assume that it doubled from where it is about now, which is as of their most recent quarterly filing, was about 164 million. So then with that, we get a price per share of about 14.5, and you can currently buy it on the public market for about 11.2. So over that 4.5 year period from halfway through 2021 to 2025, we get an average annualized return of just under 6%. Now, because the shares outstanding balance is going to be very unknown, it's very hard to predict what it's going to be, I included this here, which is a sensitivity analysis. So how does our average annualized return over that 4.5 year holding period change depending on how many shares they have outstanding, assuming all our other assumptions hold. So the revenue assumption, the EBITDA margin assumption, the EV/EBITDA multiple, and all that stuff. So it gets a lot more attractive the higher up we get. So 250 million shares outstanding, we get an annual return of about 12.5%, which is pretty good. The TSX as a whole usually does about 9 to 10% per year. If you're looking at long periods of time, so periods of time like 40, 30 years, it's about 9 to 10%. So that beats the market, so that's good to see. But if we get lower, then the return can actually get negative. So even though their market cap increases, as we're projecting it to increase, if it takes a lot of shares outstanding in order to increase that market cap, which again can arise from just making all these acquisitions and convertible securities, that type of stuff, we can actually get to a negative return. So a negative return, despite the market cap increasing, that illustrates the effect that dilution has on your company. So you need to keep an eye on this as going forward, as you would with any company that's acquiring a ton of other companies. So clearly from doing this valuation, we can see what the key issues with this company are. They relate to how fast can they grow their revenue, how much of that revenue growth is going to relate to organic growth in their existing businesses versus just acquiring more growth by acquiring more companies, which dilutes the shareholders. How many shares outstanding will there be into the future, which is something you need to kind of keep tabs on as the business continues to grow and scale up. And then what kind of an EBITDA margin, EBITDA multiple can you expect? So those are kind of things you want to keep your eye on going forward. Now, you also want to kind of take this valuation model I did and determine for yourself, do you think my assumptions were too aggressive or do you think they were too conservative? Because if you think they're too conservative, then maybe you would want to adjust them a bit and say, I think the company's going to grow more, therefore I think there's more upside to this investment. But if you think that these assumptions I made were aggressive, and even despite these aggressive assumptions, we're only looking at about a 6% estimated average annualized return, then you'd say, okay, maybe this investment is a bit too risky for my taste. I did try to make as reasonable assumptions as I could, but it is very hard with such a new and kind of upstart company like this one. But what I would recommend to you, if you are someone who is interested in investing in this company, is to learn more you can about the businesses that they're acquiring, right? And also learn what value is being created by buying all these businesses and merging them into one larger, more consolidated business. Because that's really where you're going to make your money with a roll-up strategy, is through the synergies that are created. So they mentioned cross-selling, right? So because they said cross-selling is going to be one very value-add thing by combining all these companies, you're going to want to look for evidence of successful cross-selling in the future. So future reports, if you are very invested in this company, you go on earnings calls, that could be a question you pose to management. Say, hey, how is cross-selling going? You guys said that you would be very good at doing cross-selling between services. How's that going? Is it generating revenue? That type of stuff. You'd also want to look at cost synergies, right? So they mentioned cost synergies. That's a big reason why you would want to invest in a roll-up strategy. So you'd want to look at the percentage of certain costs in relation to their revenues, right? So is their gross margin expanding? Is their operating margin expanding? Is their EBITDA margin expanding? Because keep in mind, the model we did assumes that their EBITDA margin basically doubles, right? Which is a pretty aggressive assumption to make. I do think it is reasonable to assume that it can double just based on what the company has publicly said their strategy is, but we don't know that for sure. So those need to be things you're looking at, right? Cost synergies and cross-selling. But this is definitely an interesting business to keep your eye on. I mean, me personally, I don't think I'm going to be looking into this business any further, just because with a roll-up strategy, you are kind of putting your faith in management's ability to execute on that roll-up strategy and make very good acquisitions. And just for me personally, it's really early to tell. This is a very young company, but if you are someone who likes to stomach a bit more risk, I do actually see pretty good potential in a business like this. I like the industry. I like the services that they're providing. I do think that those are services that are going to continue to grow into the future, and they're not overly expensive. There are a lot of tech companies that are in growing industries, and at present time their valuations are just sky high, and you can't really justify investing in them. But this company, they're more reasonably priced, so they are definitely an interesting investment. But anyways, guys, that pretty much does it for me. So thank you so much for listening to my analysis. If you did enjoy the video, then please leave it a like and subscribe if you're new to my channel. I do have plenty more videos like this planned, and I'll see you in the next one.